All right. Matt the Mortgage Guy, live Q&A, November 1st, 2021. Back again every Monday at 6 p.m. Pacific Standard Time. I'm on here for at least 90 minutes answering any and all mortgage questions, giving honest feedback, whether you're in the market purchasing, whether you're a fellow loan officer, whether you're a real estate agent, whether you're just interested in mortgage and how mortgage works and what's true and what's not out there. Here to answer your questions. Every week we start, and generally it's been no agenda. It's just been let's go where the questions take us, and never cease to amaze me with all the awesome questions that are asked. I never know what to expect, which makes this exciting and fun for me. As a mortgage originator who's originated thousands of loans, hundreds of millions of dollars worth of mortgages, I've seen quite a few things, but still, each and every week I'm hearing new stuff, new circumstances, new scenarios that I have not heard before. So keep that stuff coming. I'm really enjoying it. Just got back from Disneyland with the family and having an awesome Monday. Thinking a lot about client experience. You know, when you're growing a business of any kind, you can't help but look at other businesses and how they operate. And, you know, whether it's mortgage, whether it's real estate, whether it's Disneyland, whether it's anything else, at the center of most businesses is client experience. So, you know, as we delve into different people's questions on mortgage and whatnot, I'd love to hear feedback from anybody who's completed a mortgage transaction, who is currently involved in a mortgage transaction, on what exactly matters to you from a client experience perspective. This is something that's probably, you know, up there in terms of topics that get discussed on any mortgage team. I know me and my team are constantly trying to solve the riddle, right? How do we do this or that, or how do we improve this process or that process, with the ultimate goal being a 10 out of 10 client experience, right? So some food for thought. I know right now, something that is really interesting to me, because I come from let's educate folks as much as possible. Because when people are educated, they feel empowered to make decisions. When people are educated, they feel more comfortable. When people are educated, big, scary real estate transaction, mortgage transaction is a little less scary, right? And something that I've noticed, a constant, is that most people, when entering a transaction to purchase a home, get a little bit overwhelmed because they're hearing from the real estate agent, the mortgage company, and the title company. And they don't know who to respond to with what. What does the title company need? What does my real estate agent need? What does the mortgage company need? I've got to fill out disclosures here. I've got to fill out this info for the title company. I've got to set up, you know, this inspection for the real estate agent. And so that's a current project for me and my team, is really making it clearly defined for the consumer, not just us and what we're handling, but the whole picture, right? What the real estate agent is handling, what the title company is handling, what the mortgage professional is handling, and who you're going to provide what to, where, when, and why, all that stuff. Anyhow, so good evening to you, Kevin. Appreciate you, man. Appreciate the consistency of you being on here every single week, commenting on the videos and whatnot. So thanks for being here. Arslan Raha, thanks for being here. Appreciate you. Linda, another regular. Good to see you here. What's up, Miss Taylor? Appreciate seeing you here. I mean, you guys can speak from experience. You guys have done mortgage transactions. What on your side is something that you've seen that's well done, something that you've seen that could be improved upon, something that seems to be lacking? Any and all advice I can get. I'm asking real estate agent partners the same question, financial advisor partners the same question, the consumers we're dealing with the same question, because you know, it's important in any business. And for us specifically, we're scaling and growing like crazy. And so it changes, your process when you're doing 15 or 20 pre-approvals a month and closing 4 or 5 deals a month is a drastically different process than when you're doing 100 pre-approvals a month and closing 40 deals a month, right? It's a different type of animal. It's a lot more complicated process, to be honest. There's different people handling different things. When you're first starting out, I mean, I speak to this and I talk to plenty of brand new loan officers, dabble in a little bit of coaching and mentoring. And, when you're a one-man show, you're having an initial conversation, you're pulling credit, you're taking application, you're collecting docs, you're doing the pre-approval, you're setting up scenarios, you're submitting the loan package, you're collecting conditions on the file. Like, you're doing it all, right? As you grow, that's impossible. So there's more people in there doing more things. What's going on with this, like, lighting? It keeps changing. Like, when I move, lighting like adjusts. Is that StreamYard? Oh, that's weird. I wouldn't know how to fix it, so I don't know if I should try. Camera. Advanced options. I better keep it on standard definition. I don't know. I'm not going to mess with it. Gary Becker, here's a loan or a mortgage specific question. If you get 2 loan estimates from different lenders on the same day, should you expect the par rate to be the same, but different points on the rate sheets? No, you should never expect them to be the same. You get a loan estimate from me, and you get a loan estimate from a bank, and you get a loan estimate from a direct lender. Different business models, different margins, different rates, different everything. I might be 299. The bank might be 3.125. The direct lender might be 3.25. I mean, it's going to be different, right? And truth be told, you might deal with broker A, who's 299, broker B, who's 3.04, because margins are set different at two brokers, right? You might deal with credit union in Sacramento that's got a different price than credit union in San Francisco. Credit union in San Francisco is operating off thinner margins, bigger loan balances, something like that, right? So different lenders have different pricing. That's something that you can take to the bank. And so yeah, you want to get loan estimates same day because rates change every single day. And what you can expect is that 1 month from now, if lender A was better than lender B, it's probably the same a month from now, even though lenders will price more aggressive, price less aggressive, depending on the market, depending on their strategy, depending on different things. So it's not necessarily always the case. But another thing to consider, Gary, is that let's say I'm 299 at par, no points. Another lender is 3.125 at par. It costs a half a point to get 299 with them. Costs a half a point to get to 2.875 with me. The increments, like my 275 versus their 275, might be even bigger spread. I might be a point. They might be 2 points. Whereas on other stuff, we're only half a point off. I don't know if that makes sense without seeing something visually, but different lenders, different pricing for sure. And that's like one of the things to think about, right? Is the rate and the cost. Besides that, there's going to be underwriting fee, processing fee, admin fee. Some lenders have all kinds of stuff. I've made a business decision with this transition to U mortgage, underwriting fee, processing fee, basically absorbed by my branch, my California branch of U mortgage, absorbing those costs. We're trying to go bigger, badder, faster, whatever the heck you want to call it, more business, less profit per deal, but more deals, right? So where there used to be a 1055 underwriting, used to be a 695 processing. That is zeroed out, right? So I might have 299 with no other costs at all in box A. If another lender has 299, but they're a half a point plus a 1055 underwriting plus a 795 processing, that's not only the cost of the rate worse, but the other fees involved worse. Long-winded answer. Good evening, Felipe. Everyone's moving to Tennessee, man. What's going on in Nashville? What do you guys got going on out there that's so intriguing? I literally have talked to investors, people who are buying new primaries, all kinds of folks. And Tennessee whiskey keeps coming up. That's where everyone's moving. I don't know what it is, but you guys got something good going on out there. All right. Arslan Raja. Maybe it's Raja. Sorry. Long weekend of lots of Disneyland. I'm tired. Cash out refi. Well, this is a pretty vague question, but I'll attempt to answer it. Let's say that you've got great credit. Let's say that you're going to do, you know what? Why take guesses? Raga? RAGA, is that? Raga. No? I don't know. 835. Okay. Value. How much your loan is going to be, right? Like, do you want to go 75% LTV? Do you want to go 60% LTV? Do you want to go up to 80? Is it your primary? Tell me all this stuff. I'll give you super accurate pricing. Let's see. Oh, now you're changing it. Now you're giving me J's? Raja. Yeah, RAGA is not Raja. I don't know how to do it phonetically, but Raja. All right, Raja. Tell me more. $300,000 loan amount? Worth 550? These are the things. Refinance, cash out. These are the things we got to know to actually make it a 200,000 equity doesn't tell me anything, bro. Loan amount? 350 loan, 550 value. 300 loan amount, 500 value. That's 200,000 in equity. También. All right. I'm going with that. $300,000 loan, 500K loan amount, primary residence, 835 credit score. You're probably, and I say, well, yeah, like 3.1. 3.1 without paying any points. You want to pay a half a point and get 299. You want to pay a full point to get 2.75? Not recommended. But yeah, 3.1 without paying any points. That's probably your best bet for that scenario. Cash out refinance. Remember that cash out refinance is slightly higher rate than a rate and term refinance. So that's that. It's good to have lots of questions. Fast and easy way. Yeah, this Q&A is awesome. The Q&A is great because I'll get somebody's question that might come across on YouTube or email, and it might be 12 hours, 24 hours, and you respond to it, realizing like there's some other stuff that needs a bit, pinged back and forth a little bit. And that's why these lives are gold. I'm talking to this company called Hi-Ho. It's an app. And you can do video questions. Then I respond with a video answer. They're going to, when is that meeting? I feel like I have a meeting with them sometime soon. Then they're going to stitch those together. Video question and my video answer, and create little content snippets with that. I swear I had a meeting with that guy. Well, it's on my calendar somewhere. It's a new app called Hi Ho. It's pretty cool. I remember like 6 months ago, I think Gary Vaynerchuk mentioned something, and I popped on there and messed around a little bit, but it'll be fun. It'll be a, similar Q&A as YouTube Live, but by, submitting it through the app, it's gonna live in kind of an inbox, and I'll be able to pop in and be like, oh, that was a good question. I'll respond to that. Respond to it. It's a video question. I respond with a video answer. They get stitched together, and everyone gets to see it. Everybody wins. All right. What's the best way to go about buying residential real estate under an LLC while still financing? I think that the question is why. Because from what I've seen, on the wholesale side, lenders don't want to lend to an LLC. They want to lend to you and have you, personally guarantee it. If you're trying to buy through an LLC, you're going to inevitably take worse terms. And so if you're doing it through an LLC just for like the liability protection, then purchase it in your name, get the best financing possible, conventional financing, then transfer ownership into a LLC. I think that that's what a lot of folks I know have done. That's what I've personally done. And that way, Trace Piscato's Properties owns, the ownership is in the LLC, where somebody, gets hurt or somebody tries to sue for whatever reason, you're protected in that way, right? If it's some sort of partnership, or you're trying to like go out and get financing because you're maxed at 10 finance properties through your personal name or something like that, then it's going to be some sort of portfolio lender, non-QM lender that's going to say, okay, we're cool with lending to an LLC. All right, Miss Taylor. Staying within my preferred payment could be done better. Brake said payment included both conventional and FHA, including PMI based on 5, 10, and 15%. You may do this already. Oh. Okay, this is feedback for me saying like what can be done better, what's well done, what could be done better, and whatnot with the current loan process or who you've worked with. Staying within your preferred payment. So you communicated what you were looking to pay per month, what was comfortable for you, and the lender listened, right? So I think that is chalked up under listening to client. I'm taking notes because I like this stuff. Could be done better. They said payment included both conventional, if approved, and FHA, including PMI based on 5, 10, and 15%. So what about that? What about that could be done better? I guess that's the only thing that is unclear there, Miss Taylor, is when you're given those scenarios, both conventional, both FHA, 5, 10, 15%. If they stayed, within your preferred payment, what was the rub? What was the part that you thought could be done better? All right. Trying to find out best strategy to cash out refi for investment property. If this is an investment property, I take that 3.1% back. Because rates aren't that good for investment property. Probably a half a point higher. I'm pricing it for you right now, so that I'm not lying. Without paying any points, you're closer to 3.6, 3.7. If you paid half a point, you can get it to 3.5. Pay a full point and get it 3.375. Depending on how big the loan amount is, you probably don't want to pay a full point. Half a point though, 3.5. And I'll call you, or you call us, right? We'll call you guys tomorrow morning. Cool. Give us a ring, ping us. I'll put this up real quick. Greatmortgagebroker.com. No matter where you're at, California, Texas, Florida, Tennessee. GreatMortgageBroker.com. I promise you, it's only 6 questions. It's easy. All we're trying to figure out is who you are, what you're looking to do. All we want to do is give good advice. If we can help, great. If it's not something we can help with, we'll give you some good advice in relation to that. If it's something in California, once we have good information from you on how we can help, it's going to get directed back. Me, Michelle, somebody on my team, we'll put you in the calendar. We'll set up a phone call to discuss. So go to greatmortgagebroker.com and fill out that quick little form, Arslan, and we'll help you out. I was wondering what this was referring to, and I think this is referring to Tennessee and why Tennessee real estate's gone crazy. The housing market went crazy after the NFL draft a few years ago, and also country music and amazing restaurants. I don't know if it has anything to do with the draft, but I know Nashville is known for its music, so could be the music that's bringing people in the amazing restaurants. All right, Johnny Stash. This is a good question. I appreciate it, and I hope I can give you some good insight. I'm tired of getting outbid. Do you recommend I waive all contingencies to get a home? If not, which contingencies should I keep? This is something that I'm curious to know what market you're in. Still happening in a lot of areas, still happening Sacramento and surrounding where I'm at, other areas of LA, Orange County, Santa Clara County. I do business all over California. So I talk to clients, real estate agents all over California. And truth be told, this is frustrating, right? And so you're putting in offers. What the heck do I need to do? How do I get an offer accepted? I promise you, you don't have to waive all contingencies to get an offer accepted. I had a client who's a personal friend who said, Matt, like, I want to waive all contingencies. I want to, make it as strong as possible, right? And truth be told, I've seen 24 offers get accepted in the last 60 days where there's an appraisal contingency in place. Maybe they're saying we'll agree to pay up to $30,000 above the appraised value or up to $40,000 above, but still an appraisal contingency in place. There's a loan contingency in place, inspection contingency in place, and offers are getting accepted. I think that like in the hottest of markets, maybe you got to waive the appraisal contingency. Maybe you have to waive or shorten the loan contingency, right? This is where it's super important to have super high quality professionals on your side. If you've got a lender who's very thorough with a pre-approval, you can ask, is there any chance this loan doesn't get approved? And if you make $177,000 a year, have little debt, and you're trying to buy a $600,000 house with 20% down, you've got verified funds in the bank, you've got W-2 income that's been consistent for 7 years, the loan is an absolute walk in the park, I'll say, listen, your loan, there's no trouble with your loan. You can waive your loan contingency and you're good, right? Then you talk to your agent and say, listen, if I waive the appraisal contingency, I understand that it might come in at 570. The high quality agent can say, listen, stuff is sold at 585, 575. Like there's no way this thing comes in at less than 570. You might have to bridge that $30,000 gap if it comes in at 570, but it's never coming in at 550, right? And so if you're willing to pay the $30,000 gap, just waive it all together, right? I don't recommend, and I don't think many realtors would recommend it either, waiving an inspection contingency. Even if a house is only 15 years old, there can be sewer damage. There can be, mold, a collapsing roof, all kinds of stuff that you definitely don't want to just be like, yeah, we'll buy this house no matter what, right? Which is what you're saying. You're basically, when you're waiving everything, you're submitting an earnest money deposit and saying it's yours if I don't proceed with this transaction, no matter what we uncover, right? And if you uncover foundation issues, sewer issues that are $30,000 in repairs, like That's something you want to be able to say, hey, listen, I don't think this is the house for me, or let's renegotiate, right? So if you're asking me, and I think this is the second part of the question, what contingencies should I keep? At the bare minimum, the inspection contingency. If you waive appraisal, make sure that you understand worst case scenario. 570 is the minimum, right? The minimum it would appraise at. I know that if it does, I'm going to bridge that $30,000 gap, put this much down. This is what I'm going to need out of pocket. Any half decent lender can show you what that worst case scenario looks like. And then with the loan contingency, you have to have an open conversation with your lender. Because I've had plenty of these, right? And I've had plenty where I'm like, listen, if you don't quit your job, there's no way this loan doesn't go through. It's rock solid, right? I'm willing to put my reputation on the line and say it's rock solid. Other cases, you're self-employed, you've had a change in income, you've had some things happen. I've had them before where I go, listen, if I was you, I wouldn't waive your loan contingency. Like this one, as is, looks good. We've told you you're pre-approved, but there's no guarantee. And I've even had clients proceed, waive loan contingency, which is fine, right? It's their deal. You're free to do what you want, but ask the advice of the lender. Most lenders, myself included, are not going to go out on too far of a limb unless it's rock solid. And in that case, I go, yes, it's rock solid. I stand by that. Or I say, listen, it's just there's too many moving parts. Self-employed, you move jobs here, you did this, and then leave it up to you, right? So that's my best advice. Best of luck to you. I don't think you have to waive them all. Depending on your market, sometimes, and this is not a knock on any specific, sometimes clients and real estate agents think it's harder than it is. Or an agent had a hard time with one client in one neighborhood at one price point, and then comes to you and says, listen, you've got to close in 19 days. You've got to waive all contingencies, and you've got to bid 20% above that, like list price. You got to do this when it might not be the case, right? So yeah, that. All right, Gary. What were we talking about before we started talking about, two loan estimates? What determines reserve requirements? Excellent credit. Reserves are going to be needed when you own multiple properties. They're going to be needed when you are doing a jumbo loan. And they're determined by the lender you're sending the deal to and the automated underwriting findings that lender gets from Fannie and Freddie. So I take your deal, I submit it to the automated system. The automated system says 3 months of PITI required in reserves, meaning 3 months of payments, principal, interest, tax, and insurance. Now, the lender that we send the deal to might say, yeah, I know the minimum is 3 months with Fannie and Freddie. We want 6 months because that's their deal. If you're a specific type of buyer buying a specific type of home, they want 6 months. And so it really all depends. But those two scenarios are the most common where reserves are needed. If you're a first-time buyer buying a house with 5% down, most of the time, you're not going to need any reserves, especially when you have excellent credit. If you are an investor buying investment property number 5, the lender might say, we need reserves for each and every property. 3 months, 6 months. There's more risk, right? More things that can go wrong. But it's dependent on scenario. And then jumbo loans, 3, 6, 12 months. It's common. What's up, Zeta? What's new in the real estate world? I don't know. I guess I saw a headline that Zillow's selling stuff for less than what they bought it for in Arizona and other markets. People are wondering whether or not it's going to come to California markets. I've got a bunch of clients getting their offers accepted. That's what's happening in my real estate world. But yeah, I don't know if I've seen a lot of real estate related news that's real exciting. Sylvester Stallone listed his property. still these articles. Foreclosures are shooting up. Is a repeat of the 2000s housing crisis. Get the out of here with that. Housing market. That's a good question. I've been in Disneyland all weekend. I haven't been watching real estate news. I've been riding roller coasters and doing fun stuff. I wonder how Orange County real estate's doing. So it's down in Orange County. Yeah. All right, Kev. So you had the question about LLCs, and you're basically saying it's asset protection. Buy them in your personal name and then transfer ownership to the LLC. The price you pay to do that transfer, and someone could do a deed transfer for $200 or less, probably, is a lot smaller price than paying a % higher in interest for the life of the loan, right? Only trick with that, an attorney told me, and I'm not an attorney, so this is not attorney advice. This is for entertainment purposes only. Just a mortgage guy. NMLS number 1088993. I just took my continuing education, so I'm as smart as I've ever been, but I'm not a lawyer, so I'm not giving lawyer advice. If you purchase the home, just your name, 100% ownership, transfer it in an LLC that's 100% ownership. If it's a 50-50 deal, and then transfer it into a LLC that's 50-50, you're fine. You just don't want to go from like 100% to then an LLC that's 50-50 owned. Something like that. The lawyer told me one time. All right, Linda. We saw a Zillow-owned home we love, but it has mold, roof leak in the garage. Have you seen Zillow making repairs? I feel like they should or would. And would it be a problem with a VA loan? 100% guarantee it's an issue on a VA loan. Anything health and safety, and mold and roof leak are health and safety both, is going to be an issue with a VA loan. So VA is going to require that stuff is fixed, require a 2-year roof cert, require mold remediation or whatever needs to be done there. So I don't know the answer to the question though on whether or not Zillow is going to do repairs. I would hope so. Am all in. I'm laughing at this question because it made me laugh. A selling agent is calling lender to tell them to use a different appraiser and suggesting year-old comps. One, it's very unlikely appraiser's ever going to use year-old comps. It's possible. We heard from Ryan Lundquist on this channel about, the scenarios where it might be needed. You can rebut an appraisal and ask them for a reconsideration of value if the agent has things they really missed, right? Like, oh, here's a comparable that was a model match. You should have took this one in consideration. Here's something you didn't mention in your report that, from what I've seen as a lender who's seen thousands of appraisals, is the selling agent will get upset and say, oh my gosh, this should have appraised for this number. I can't believe it. I got 7 offers. This appraiser's an idiot. Yada, yada, yada. I say, listen, we're happy to help. We'll submit a rebuttal, and we'll try to get a reconsideration of value. Go ahead and provide, 3 comps they missed, any notes that you have that support the value that you think it should have come in at. And they've got nothing to support it except for they think it should have came in higher, right? You look at a report and you go, okay, they appraised it at 550. There's comps for 540, 545, and 532. 550 was probably generous. So this listing agent that thinks it should appraise at 600 just pulled a number out of the sky. So I don't know. I don't want to knock all listing agents because some of them are reasonable. Some of them know what the heck they're doing. Some don't. All right, Arslan, Maryland. Fill out that greatmortgagebroker.com. We'll set you up nice, man. I got some good folks in Maryland. All right. This is good feedback, Miss Taylor. I appreciate it. And this is probably something that we personally could do better at, me and my team. Make assumptions based on everything we know. Like in this case, the lender probably said, listen, 3% down conventional is way better for you than 3.5% down FHA. But as a consumer, you might want to see all your options, if nothing else, just to know that you have options. And we should probably frame it as, here's conventional, here's FHA, here's why we think conventional is a better option for you. Here's the pros, the cons, and ultimately, like, it's on you. You make the decision on what you want to do, your loan, your house, your life, your finances. So it's good feedback. I got 2 notes from you so far on client experience on a mortgage, what you're looking for. I like it. Thank you. Pros, cons. Are most people doing 50% DTI? No. Truth be told, like a lot of loans, the front end's got to be lower than 40 and the back end's got to be lower than 45 for it to get approved. Majority of loans right now are conventional loans. Way more conventional are being written than FHA or VA, USDA. And what I'm seeing, like, I would just this is a total guess. Average front end ratio is probably 30%. Average back end ratio is probably mid to high 30s. 30 over 36. If I were to guess, just random, right? Maybe even 28-36. Yes, you can have a front end ratio of 39.7 and a back end of 44.2. But not everyone's up against that, upper end. And 50% debt to income ratio, keep in mind, that's only mortgage plus all other debts. That's back end ratio. And that's VA loans, FHA loans. Conventional are very rarely going that high. VA can go even higher, but it's not something that's like every single loan. Harminder, thanks for coming back, man. Appreciate having you here. Are refinance rates higher than first-time loan? A purchase is what you're talking about. They should be fairly similar. Sometimes lenders will give a little bit of a pricing incentive for a purchase. It'll be slightly better, but it's very slight. Purchase and refinance should be very similar when it comes to rate. Sergio Landeros. Can I use a cash out refinance on my primary and use the funds as down payment on investment? Yes, you can. 100% happens all the time. It's pretty common. And what I've seen a lot, at least in this past year or 18 months, maybe it's a pandemic thing. People are buying second homes and they want to buy a Lake Tahoe house. They want to buy a Santa Cruz house. They want to buy something that they could escape to. Sorry, someone told me before not to yawn. I guess that's a turnoff on a live stream. You can do them at the same time. And it makes more sense to do them at the same time because you're providing all the same documents to a lender. And so the lender's going to just take into account the new payment you're going to have once you do the cash out. Cash out refinance, 140,000 cash out. Your payment might go up a little bit. And so it's going to be, that new payment factored into your debt to income ratio, but you're going to use 122 of that as down payment on the investment property, second home property, whatever it is. Perfectly legal, perfectly possible, rather common. Let's do it. Give me a call. All right, let's suppose a rental is bought on cash and is in my name. We'll take a deed, transfer it to my LLC. Sure. Buy it cash, buy it in your name, or just buy it under the LLC. If it's cash, then you should be able to just do it straight into the LLC. But either way, use a deed service and transfer ownership into the LLC. All right, another good question from my buddy Harminder. Got an estimate. There's a rate and an APR. Why is the APR higher? Somewhere out there, I've got a video on it, but APR represents the total cost of the loan. So you're going to have the interest that's paid, and you're also going to have fees. And so the APR, the annualized percentage rate, is taken into account the fees as well. So it's mortgage interest plus fees. Know that this APR is a good number to know, just to say, hey, I've got 2.75 at two different lenders, but the APR on one is 2.82 and the other one is 3.16. Why is it so much higher at the other one? That 3.16 is because they're charging $7,700 in fees up front. Other ones only got $4,200 in fees, whatever it is, right? The APR factors in the fees and has a number to represent that. What affects your payment, and the only thing that affects your payment, is your interest rate. So regardless of the APR, 2.75 interest rate is your interest rate for the life of the loan, and that's what your payment is calculated off of. Your APR doesn't have anything to do with how your payment's calculated. It just is showing you interest and costs reflected as an annualized percentage rate. It's a historic house, and selling agent seems to be influencing the outcomes. Best of luck to them. Hey, Linda. Sure. A roof cert is basically something that lenders will call for if a roof seems to be towards its, what do they call it? End of life. They'll basically, if an appraiser comes out and is like, this roof looks a little bit shaky, underwriter sees that in the appraisal report and says, listen, we'll do this loan. We need a 2-year roof cert. Somebody needs to come out and certify that the roof has at least 2 years of life left. And that's what roof cert stands for, roof certification. And 2-year roof cert is the standard for lenders to say, if this thing will hold up for 2 years, we're cool. Badass Tweeb. Oh, Badass Tweety Bee? Thanks for joining. Do we offer good refinance rates? Yes. We're a broker, so we're better, faster, cheaper. Pittsburgh, California is what I'm guessing. Antioch, California. I do loans all over California. Hundreds of loans every single year, from the tippity top of California to the very bottom. So feel free to reach out to us if you would like. There's a couple different ways. Let me see. The best way is just go to greatmortgagebroker.com. 6 quick questions. That'll get you looped in with the team. We'll get you on the calendar. We'll chat with you. We'll see how we can help. If you wanted to send me your scenario to look at for a refinance, current credit score, mortgage statement, what your goals are, you can shoot that over to matt@mathmortgageguy.com. Let me know what you're looking to do. We're happy to help. But probably your best bet, greatmortgagebroker.com. Fill that out. Let's get rolling. Monty Taylor, appreciate you. $2 super sticker. First one of the night. Monty Taylor gets the win for the first super sticker of tonight's stream. Appreciate you guys. I don't know how many people have smashed the like button, but I'm going to pop on over and take a look on how many likes we got so far. It looks like only 13, but I'm going to pop on over and take a look. What I do? I paused it. I just wanted to mute it. There we go. All right. Let's get that. Let's smash the like button for the YouTube algorithm. I have no idea if it matters. I honestly don't know if it does or don't know if I care, but let's do it anyway, right? We're up to 17 now. Appreciate you guys. Wow, that's kind of cool. It updates it in real time. All right, now I feel better. We got 20 likes. Zeta, yes, do loans on the East Coast. As I'm making this transition to UMortgage, shout out UMortgage. We're dialing in the process. To me, as I've said many times before, client experience is the number one thing. Keeping a good reputation is more important than anything else. And so as I've grown my business in California and, $100 million a year plus funded in just California, I've feared getting too big too fast. And so as we start to get licensed in other states and as we start to expand, the decision was made by me and some of the folks around me at UMortgage. I'm going to connect you with somebody who's an expert in your specific market. Once I'm able to get my secure footing, get on board with UMortgage, and set up the teams, then it's going to be, all handled by the Math and Mortgage Guy team. And for now, I'm getting help, right? If you're in Georgia, I'm going to connect you with somebody who's my Georgia person. If you're in Florida, Florida person. If you're in Tennessee, Tennessee person. Until we can ramp up, scale up, and have a 30-person team that can handle the whole kit and caboodle. Hey, what's up, Harminder? This is a great question. A lot of people really are confused on this. And so I'd love to answer this. I'd love to provide some clarity because some people think that you put 20% down versus 5%, your rate is a lot better. And I'm going to tell you 5% down, 10% down, 20% down, the rate is almost identical. At 5 and 10%, you're going to pay mortgage insurance. So when you're looking at pros and cons, you've got that. But 5, 10, 20, almost identical when it comes to interest rate. When you put 25% down, the rate gets slightly better. When you put 30% down, slightly better than that. 40% down, slightly better. And that's kind of where it tops out as far as, diminishing returns. But, from 5, 10, and 20, let's call it 3%. If 25% and 30% are 2.875, that's about it. You're not going to get more than an eighth by putting a larger down payment. It's going to be fairly close, right? But it is different. On the rate sheet, you are going to get slightly better pricing. And know that in mortgage, it's not always like, the rate gets better by a full eighth or a full quarter, but 299 might cost a half a point. Then you put another 5% down to go 25% down. And now it's no points for that same rate. All right. We're happy to help, especially them California folks. Our neighbors in California. We're happy to help everybody, though. That's a better answer, Mateo. All right, Zeta. When does PMI go away? It's a great question. If you've got an FHA loan, and you put 3.5% down, you purchased, it's been 5 or 6 years now probably where that's not going to go away. PMI is just on there for life. If you got a conventional loan, it's going to fall off when you reach 78% loan to value. If you just make your regular payments, that might be 8 years out. You can, if you've made payments and your house has gone up in value, connect with the lender, the servicer, and say, hey, listen, this house is now worth $500,000. I only owe $342. Remove mortgage insurance. They've all got different processes. They might do a drive-by appraisal. They might do an automated value. But whatever the case, you should be able to get that removed once you reach 78% loan to value on a conventional loan. Know thyself first. I'm almost close to my 10 loans. Anybody who's wondering, Fannie and Freddie conventional loans, the best loans out there, the best terms, you're limited to 10 per person, meaning that once I have 10 personal loans, Fannie and Freddie says, no mas for you. But I have a lot of investor clients who structure this in a way where husband has 10, wife has 10. This specific scenario is a common one, so I'm glad the question was asked. Thank you for the question. Can my wife get 10 on her own? Does she have to have enough income to qualify on her own? The answer is yes, she can get 10 on her own. But again, yes, she has to have enough income to qualify on her own. And so, this is a tricky one, right? Because you got to have income from both partners if you're going to put 10 on each. And, to have 10 properties and enough income to support that, even though you can use some of the rental income from the rentals, is a pretty good amount of income in most cases, depending on how big the loans are. So, you'd have to get with the lender and look at, ratios and qualifying and whatnot. But you definitely need the income to qualify for those other 10. With the recent increase in value, how do I ask my lender to review the current LTV and drop my PMI? They've all got a different process. I know that, I send a lot of loans to UWM and Home Point and EPM, and they've, any of them, you reach out to the servicer, customer support, and say, I would like to remove PMI. They've got a standard procedure on how they do that. So reach out to them and ask them what their specific process is. Arslan, Gouge. That's it. Matt Gouge. It's actually got an accent mark on the E. So bam. Gouge. Oui, monsieur. My guess is, what are you doing? Googling? Making sure I got good reviews? Matt Gouge, U Mortgage. Oh, man. Look at that. All good. All good. Monty Taylor. Another super sticker. I appreciate it. Let me know what I have done to earn those super stickers. Whatever it is, I'll do more of it. Me and the team are happy to help. All right, Zeta. Yeah, if you have PMI on an FHA loan, you have to refinance to make it go away. The only caveat is if you did a refinance of an FHA, you did an FHA refinance, 90% loan to value or less, it will fall off after like 11 years. But nobody's keeping their loan for 11 years. When I say nobody, I mean most people. So that's that. I have some lenders saying they don't need the 6-month seasoning and do a 75% cash out refinance for a rehabbed Burr property. Good luck, because they wrong. The right answer is you need 6 months to use the new appraised value. You can do all the delayed financing you want and buy cash, rehab it, and refinance. But I promise you 1,000% guarantee, because I've worked with a bazillion investors on a bazillion loans, and I know the guideline. If you bought it for 200 and you put 80,000 in rehab into it, and it's now worth 400, you cannot, I repeat, cannot do a loan above the $200,000 purchase price until you reach 6 months. No, if it appraised at $500 million, the purchase price is the max loan amount until you get to 6 months. Once it's been seasoned for 6 months, you get a new appraisal. It's worth 400. You can refinance up to 300,000. That's a true Burr. You get your whole 280 back, plus carrying costs, plus whatever, right? And so you're made whole again. It's a true Burr. If you tried to do a refinance within those 6 months, a conventional loan, I'm not going to speak for portfolio loans or whatever kind of other stuff is out there. The purchase price is where you're capped on loan amount. The people that say you can wrap in, funds you use to rehab, full of shit. People that say that you can, go up to 75% of the new appraised value under 6 months, full of shit. It's just not true, right? So I've dove as deep as you can dive on this stuff because I've done a lot of that. So know thyself first. I know thyself, thy mortgage guy, and I'm not certain on a lot of things. I'm certain on that one. My guess, since you're an investor, is you're talking about investment properties, right? Rate difference between a single unit, duplex, triplex. Single unit, you're going to be, let's do purchase here. I'm going to price it because I'd rather not guess. It's going to be something like 3.625 on a 25% down purchase with a single family. And then I'll price dub and trip. Duplex, triplex, quadrupleplex. Single, 3.6-ish. Duplex. Yeah, you'll take a hit too for having more than 4 finance properties, a small hit on the pricing with all lenders, really. It's just the price you pay for being a big shot, It's really the price lenders charge you for a little bit extra risk. It's going to be about a half a point for 3.875. You know what I can do? I should be pricing it. I got a pricer for multiple lenders. That's probably the best, though. Pay about a half a point, 3/4 of a point for 3.875 on a duplex. And then triplex, going to be a little worse than that, is my guess. And to answer this question of yours, have they gotten better? Not really. Slightly better, but most of the lenders that weren't worried about this were the best price lenders, where they're like, we're not going to worry about that. We got 3 or 4% that are going investment right now. If we take on some more, we'll still be under the 7%. And so, I didn't see a big rate improvement once this got lifted, to be completely honest. Oh, 2 and 3 are the same? That's interesting. Yeah, so about 3/4 of a point cost for 3.875 on a duplex triplex. And then you get 3.6 for little to no cost. on a single family. So not a huge difference. Home style renovation loan is like conventional's version of FHA 203K, which is you bake in the cost of the rehab to the purchase. I don't think a lot of these are done conventional. I just haven't seen very many of them at all. In a market like we have right now, where the stuff that needs work is getting bought out by cash buyers, this loan type and purchase is very uncommon to get accepted. So people just aren't using it. Same kind of goes. Like, I feel like FHA rehab loan, home style rehab loan, down payment assistance, like these products are not seeing a lot of action right now because people understand like you can't get an offer accepted. If the property's run down and needs rehab, there's cash buyers lined up for blocks. Just going to buy it cash. They're going to rehab it, sell it to a retail buyer at a premium because there's so much demand. So unfortunately, that's kind of the state of the market, right? If things slow down, stuff sitting on the market for 60 days and people can go out there and use these type of loans to get financing, then maybe they make a comeback. But like somebody was asking me today about a certain product that AFR has that's down payment assistance. And I mean, down payment assistance in any California market is just going to be tough. Really, really tough for someone to get offer accepted. So I just don't see it being used. Oh man, look at you, Arslan. I see you. Refinance cash out. You're already rocking and rolling. Cool. You're in there, man. You're in the system. Let's roll. Harminder. Maybe. I mean, this is a slippery slope, right? Because sometimes if I quote something and there's a lender out there that is off by 50 basis points, like, well, let me get a price exception from my lender to be able to compete and match that. It might happen. You know, generally it's going to happen in an environment where one lender is probably knows that they're priced a little bit out of the market, and so they're able to on deals here and there give a price exception to kind of price match. So I guess the answer to your question is, yeah, it might happen. You gotta be careful though, because the best of the best rate quotes are from the trash of the trash lenders. A good example of that is Provident Funding. Anybody who's been a broker for any length of time knows Provident Funding is an absolute dumpster fire of a lender. And, you know, they're the best priced. I made the mistake when I was new to loans, or new to the broker world, I should say. I'm like, oh, that's pretty sharp. Let me send some deals over to Provident Funding. Absolute nightmare for me and my team, for the client, for everybody, right? And so if it costs you $800 more to use a lender who can close a deal in 22 days and the process is a walk in the park, I think most people's time, energy, and sanity are worth it, right? You're spending $500,000 buying a house and, you know, trying to cut corners and save a few extra bucks to work with a trash lender might not be worth it. Is it easier to sell a fixer than a non-fixer? I don't think so. I think that in this market, everything sells relatively quick, but you get something that's well priced and that shows well, it's going to fly off the market. And when I say shows well, it's pretty. You know, it's got nice floors. It's got white countertops. Those turnkey ready, is a term to describe it. Homes that a couple walks through and they're like, we plan to have a couple kids in the next 5 years, and this is the neighborhood we want to live in. That stuff sells, right? And so it's probably harder to sell something that's got green shag carpeting and hasn't been updated since 1964. I mean, I think the proof was probably in the data too. Like you look at a redfin.com or something, the stuff that's been on the market for 58 days is ugly. The stuff that's selling in 4 days, it's pretty. It doesn't take a genius like myself to figure that one out. But that's at least the conclusion I come to. All right, David, make $28,000 a year on my normal pay, but with my overtime, I make around 40. I've heard that mortgage companies will only count the first 40 hours of pay and that they don't take overtime into account. Not true. With that being said, do you have any advice on what I can do to get approved with only one job, or is that impossible? All right. This is some real good advice for you. Here's exactly how lenders do it. You make $28,000 base pay, normal pay, whatever you want to call it. And then you make about $12,000 in overtime. Lender's going to look at 2019, 2020, 2021 year to date. And with that, we've got 34 months of history to look back on. If in 2019 you had $9,000 in bonus income, 2020 you had $11,000 in bonus income, and then year to date you're on pace to do 12 this year, right? So you made $10K year to date bonus income in the first 10 months. We'll take all of that. I did some smart math here. 9 and 11 and 10 is 30. 30,000 divided by 34 months, because we took 10 from this year, 12 and 12, equals $882.35. That's the average of income. That's what we can expect. Average of overtime income. Then we take your $28,000 base, and that's $23.33 a month. We add $882. $32.15 a month is what we can use for income. And anybody who told you that you can only use the first 40 hours of pay is a complete idiot. Sorry. Gosh, that's not nice. Not a nice way to talk. They're misinformed, or they were, if you don't have this 3-year history, though, you can't use it. A 2-year history is what's required, but I'm saying 3 because it's going to be 19 and 20 full years, and then the 21 year to date. The lender's going to want to see you've made overtime income consistently. That's the only way they're going to expect it in the future, right? All right, now that we got more people logged in, and a lot of folks like Know Thyself First have done plenty of loans, I want some feedback on the mortgage process and the client experience. What are some things that you've seen, heard, felt in the past that were good, that were bad, and that you were like, man, maybe you've worked with multiple lenders. Know Thyself First with 10 loans. You've worked with a ton of different lenders, I'm guessing, or maybe the same lender multiple times. What are some things that lender does well? What are some things where you're like, oh, I wish they did this? I'm taking a survey because we're growing a team, and everything leads back to client experience, right? Best client experience. So besides a very clear roadmap on expectations and then delivering on those expectations, what are some specifics that you might be able to give me as things that matter to the client? I think paperwork can be improved by using data. What exactly do you mean by that, Arslan? With like, like lenders needing less paperwork if there's certain data available? All right, Helen, I'm writing it down. Responsiveness. And does this have to be from a specific person, or if you're working with a company and you've asked a question via email, via text, whatever it is, if you get a response from the company, does it matter if it comes from Matt or can it come from Matt's team? I love this. I love this Q&A, and I turned it around, guys. You were asking me the questions. Now I'm asking you the questions. Huh. All right, I agree, Arson. It's a time-consuming process when it comes to paperwork. Oh, so you should be able to connect with my ADP and get all my income info. Yeah, with some employers, that stuff's possible, and there's work number and whatnot. But with some, all right, good to know, Helen. Anybody from the team will work. Cool. Upfront disclosure of fees. Yeah, Harminder, it sounds like you're out there loan shopping and trying to talk with different folks. That's probably a really telling sign, right? And somebody's holding back information from you. It's probably you're not someone you're wanting to work with. 3 different lenders totally dropped the ball, never called back or text, just vanished. Wow. All right. Got to be able to respond the hours that you're available. That's good stuff. All right, Monty Taylor. Closed on 3 properties. Congrats. Looks like you pulled some cash out. Hopefully you're out there deploying that capital right now and putting your money to work in some stuff that's, paying you 8% while you're borrowing the money at 3.6%. 3.6% with a 0.07 discount. Maybe it's 0.7, maybe it's 0.07. Either way, good deal for 3.625 on a cash out investment property. Tell your audience to close by the 10th so you can pocket 2 months of rent. You can, and you can time it to where you miss 2 months of rent, but truth be told, it's not really like a humongous difference because you're skipping that mortgage payment. Let's say you close on November 7th, right? No mortgage payments due till January 1st. So you can not pay November, not pay December, first payment January 1st. You're going to pay November 7th to the 30th of interest up front. So you're saving a little bit. You're paying that $700 in interest, not your full $1,200 payment or whatever it is. But yeah, I mean, it's fun as an investor and as a landlord to not have a mortgage payment for 2 months as you're collecting rent. It's a little influx of capital. And you, like you said, you get the refund of the escrow account back. So it's a nice little capital influx, which right now you're borrowing the money. It's so cheap. It's awesome to borrow at 3.6, go deploy it and get that money and deploy it to earn more. All right, we're almost wrapped up. I think I'm nearing the end of what I'm able to do today before I call it a night. So final call, mortgage questions, real estate questions, whatever you guys have for me, I'm happy to give you my honest feedback. I don't know it all, but I talk to lots of people day in and day out. So I get, lots of viewpoints, real estate agents, financial advisors, other investors who I speak with. And sometimes that, influences how I think and how I advise and things like that. Real estate news today. Top stories. House flipping tips. People are still house flipping. People are still crushing it with house flipping, which surprises me. I feel like for 3 straight years, I've been like, be careful. It's kind of dangerous to flip houses, but people are still doing it. Still, I mean, man, these last 18 months, people have been absolutely crushing it. Thanks, Matt. Wash hands. Is that the advice? Wash hands in this market. Basilio. Buenas noches. Good to see you here. Yeah, I agree, Felipe. With the great questions, without the great questions being asked, all for naught. I'd just be on here with nothing to say, right? And that's really the joy of being a mortgage broker. Talking to people day in and day out, getting different perspectives, getting all kinds of different feedback from folks in different markets doing different things, right? Really good stuff. Arslan, this is a genius idea. I had somebody talk about this. I don't have a Facebook group, but a group that I'm part of, One Rental at a Time Works, is a great Facebook group with a bunch of people interacting. I'm taking a picture of this because it's a good idea, and I want to remember that. Can I take this without being? There we go. I'm thinking about that, Arslan, for 2022. A Facebook group with like a bunch of folks helping each other out. I'll pop in and answer as many questions as I can. I got to figure out a way logistically to make it work so that it's not just like a bunch of questions flying off without any answer, any direction, some way to moderate it, some way, like maybe I'd have to bring on a few moderators to help me out with all the questions, but that's a good idea, especially for somebody who's pretty passionate about educating folks and putting good information out there. Thanks for the kind words, David. Appreciate you. Lipsa. One of my friends got a 2.55% interest rate for 80% down, 0 points with First Republic. Does that seem feasible? It seems a bit fishy to me, but they said they have first-time buyer deal. Somebody's lying. But 80% down? It's a first-time home buyer program if I've ever heard of one. I don't buy it. Oh, 20% down. Yeah. I don't buy it. I agree, Arson. We'll create a good network. I totally agree with it. Have higher current comps, 1 mile radius, ready for appraisal if they take it. My appraisal was from out of the area. I got an extra $60K than I originally expected because I did my research. Profit. Cool. All right, last one. David Nettles. Would you recommend dealing with a national company like Rocket, or is it better to try to get a mortgage loan with somebody local or regional? Well, I don't recommend Rocket, mainly because they're just more expensive. Like as a broker, I can broker. I shouldn't say it. Let me step back. As a broker, if I price Rocket versus other lenders I work with, they're not the best priced, even though they're huge. They don't have the best client experience. And then worse off, if you go directly to Rocket, Quicken, you're going to deal with call center employees. It's going to be even more expensive than working with a broker. And the level of advice service you get, like I try not to knock folks, right? Like I don't need to knock down the other buildings to make my building look taller. But if you're doing a mortgage loan, you want to be talking to some professionals who know what they're talking about, right? Putting yourself in the wrong type of loan, structured incorrectly, is a bad idea. And I just see it all too often. Rocket is a big sales machine. And so they will do whatever it takes to get the loan. I've seen people send me something like, hey, how does this look? 2.625 with 3 points. And I'm like, no way on God's green earth you should ever pay 3 points up front. The person that sent you that either doesn't know what they're doing, is just trying to sell you on a low rate, and that's like what they think will attract you. But if they worked at Chick-fil-A 3 months ago and now they're in a call center at Rocket trying to close as many deals as possible, like they have no vested interest in giving you the best structured loan for your scenario. Whereas a broker who relies on referrals, that's like the main driver of our business. I'm trying to help you win long-term. And by doing that, you refer your sister, your coworker, your cousin, your next door neighbor, everybody. My business grows, you flourish, you win, whatnot. You're not going to get that from Rocket. All right. I won't go off any farther. All right. I'm not going to even open that last one from Mr. Undercover. Yep. You get a loan without interest. Go to goflyakite.com. Thanks for joining, everybody. Have a good night.